Hey everybody, so we're back on, I believe it's this 15th episode of The Growth Factor here. Ty Lasater, one of the founding partners of Lasater Capital, and I've actually got my brother Boone Lasater on this week, my business partner. So we've started our company 20 something years ago as a family business, had a couple of other partners that we brought in along the way. We've since bought them out and gone back to a family name where we are putting our name on the product that we have out there because we are committed to it and we are, that excited about what it is that we're doing right now. But something that I wanted to do a little bit differently on this week's episode, we've got over 750 investors. We see all kinds of circumstances. We get all kinds of questions. And so I've put together kind of the top 10 problems that we see as it pertains to problems that our potential or current investors have and the solutions that they're looking for, as well as some of the top questions we have. And so, Boone, I'm going to let you kind of go in and ask those back and forth, and we'll discuss through those and give as much value and content as we can to the listeners so that I am sure out of these 10 or 12 questions or issues that potential investors have, I'm sure that some of them resonate with some of our viewers and listeners right now. So, Boone, I'll give you the floor and you kind of take off from there.
Yeah, perfect. Glad to be here. Hello, everyone. So first question we're going to get into is talking a little bit about high wage earners, people that have a high W-2, they're high earners, but they're just not getting their net worth up there where they would like to see it or where they should be based on the income that they're making. So first question we're going to get into is what's the biggest mistake high income professionals make with money once their income gets good, and why does it keep them trapped when they're in a golden handcuff situation?
Yeah, well, you mentioned a W-2 earner. We've got a bunch of doctors that are W-2 earners, engineers. We've also got doctors that are 1099 contract. We've got entrepreneurs that have K1s and or partnership distributions. But we've got a bunch of, as you mentioned, golden handcuff investors. So these are people that are qualifying from an income perspective, and they're on the lower end of the net worth perspective as an accredited investor, but their net worth doesn't match their income, and we see this all the time. And one of the biggest factors is lifestyle. So a high income earner, maybe they start out at 250, $300,000, and they build a lifestyle around that, and then their income goes up to 500,000 and they increase their lifestyle. Instead of what I have seen with the wealthiest of wealthy people, and we've got some investors that are 40, 50, $60 million net worth people. We've also got a couple of investors that are approaching $1 billion net worth, individual investors. And we've got investors that have, we've got, of all of our investors, some of them have the minimum investment with us of $100,000. We've also got investors that have $7 or $8 million with us. And the biggest difference that I see is those that have eclipsed that eight-figure net worth value and they're at nine figures, approaching 10 figures, their income oftentimes doesn't change. Their lifestyle doesn't change either. What they have been able to do is live off of 30, 40, or max 50% of their income, and they put the other 50% of their income into investments. And now many of our investors are Christian. They also tithe as well, but they tithe first. Then their living expenses, they keep them minimal, 30, 40, at max 50% of their income. And so they're investing a bulk of what their income is. And so they have figured out the equation to putting their money to work for them as hard as they've worked for their money. Okay. And so now, let's say they had that when they first started out, they were at $500,000. Well, they're investing $250,000 a year. And then their income goes up to $1 million. Now they're still living on 250,000. They're investing 750,000. And so they're putting back more and more money into investments. And now the investments start to compound and the investments start to produce, and the production of, or the income that the investments make, they put into more investments. And so I think that's the biggest mistake that I see high income earners make. And I've been there. When you know this, when you and I started out, you were living on my couch and we were combining our income, what was of it, and I mean, I was in a 1997 single cab pickup truck, beater pickup truck that I think cost $7,500. And in fact, I was talking to my daughter about the truck the other day. She said, "Hey, that was one of my favorite trucks because we used to jump in the front seat with you and go to projects with you." And so, I think you've got to be able to learn to sacrifice now in order to build what you want. And there was an instance where, we went and, we had a big year. I remember our first year when we exited, I think it was in February, March of our first big year. We had a $440,000 exit that we got on the exit of a deal. We turned that into another investment. But 3 years after that, we hit like our first $1 million a year each, and we spent more of that $1 million than what we should have. Okay, and I've been there. You're on $70,000 a year and trying to figure out how to live on $35,000 a year so that we can continue buying properties. And then all of a sudden we have a $400,000 year. Okay. And we kept that frugalness going. And then all of a sudden you hit it somewhat decently and you get an inclination to go out and spend that money. You've got to learn to start managing that properly early on because, a guy that makes $1 million a year 10 years later is not worth $10 million. You've got one of two solutions there. You've got a guy that makes, and one of our investors reached out to me earlier today, who is a perfect example of this. You make $1 million a year, and most of the people spend 900,000 to a million one a year. And so they don't have any better off net worth 10 years from now than they did day one. Then the other side of that is you've got people who make $1 million a year and they spend 250,000 of it and they invest 750. Neither do they have a $10 million net worth. They now, because they've had compounding effects for them, have a 30, 40, $50 million net worth. Okay. And so typically somebody that makes $1 million a year, they either spend it all or they invest a majority of it and they have far more than a $10 million net worth 10 years from now. So that's probably the biggest thing that I would take from that.
That's perfect. Well, so let's go into our next question. Next question is we're going to talk a little bit about Wall Street or the soon to come Y'all Street here in Texas. Dallas is obviously having the new stock exchange come up over here. Super excited about that. But obviously, a lot of investors, tie into what they're watching based on what's happening in the stock exchanges and what's happening on Wall Street. So, if you had to explain in 1 minute why Wall Street feels unsafe right now, what would you say? What are specific signals that you should watch? Obviously, we've got things going on right now, like the war in Iran. We've got, the lingering problem and what's going to linger past what is supposed to be Powell's exit period as the board chair for the Fed. And getting a new confirmation, whether that's Walsh or somebody else coming in, we're going to have a little lingering going on there. And then you've got the S&P 500 is now closed down 5 days in a row below the 200-day moving average. So we're starting to see some market indicators of potential lingering recession. So what would you say to that? What feels unsafe right now, and what are specific signals that you can watch?
Well, first, I don't think I've ever explained anything in 1 minute, so I'm going to struggle with that. But I will say, there's some indicators finally that we've seen this week that are starting to feel a little bit unsafe. But I've seen uncertainty in the market for almost the last 12 months. And I'm surprised that the market has stayed at levels of that it's at its highest it's ever seen for the last 12 months. And we've seen a few little corrections here and there. A couple of days in a row, 2 days in a row, I think, a couple of weeks ago, a Friday and a Monday, it closed down consecutively 500 points both days, but then it rebounded a little bit. And so, I think we've had a false sense of security. So I'm not going to say that it's felt unsafe for most investors. Most investors have had a false sense of security in Wall Street, and that has come because you know we've seen the S&P 500 and the Dow trending at record highs over the last number of months, and what they're not seeing is the underlying factors behind that. That if you look at the S&P 500, a majority of those stock, well, first of all, you got the Magnificent Seven, which if you saw the article in the Wall Street Journal last week, um, a large data analyst that does contract data analyst work for Schwab and I believe Goldman Sachs, one of the biggest data analyst firms. The CEO came out with an article that said the Magnificent Seven, we're expecting over the next 10 years, we're expecting about 3% net gains, annual net gains in the stock market, 3% per year. Well, inflation, we already know the inflation number that we're looking for is 2.4%. It has not been at 2.4% for some time. And we know that the CPI inflation number does not take into consideration food and fuel, which when you add those in, we're trending around 4%. So forget about taxes. Just looking at inflation, inflation is going to erode all gains over the next 10 years because of the overvaluation of those Magnificent Seven. Then you take into the tax effect of that because tax is not paid net of inflation. Tax is paid on the gains. So if you're running at 3% gains, you pay taxes on it, and then you take the inflation effect. You're actually losing money. You're losing about 2% per year over the next 10 years, and that is because number one, those large seven giants are trading, on arbitrary data right now. That is AI and things like that, which has not performed quite as quickly as everyone expected. And then secondly, we've got a majority of the S&P 500 trading at 4 and 5 times book value, which is not sustainable. It is absolutely not sustainable. As Warren Buffett has always said, the stocks are going to reset to their book value, and a reasonable trade on their book value at some point. And so we will see that they'll come down to closer to 2 times their book value, maybe 3 times. We're going to see a large correction. And it's going to be like the 1999 dot-com bust. And people that didn't take chips off the table are going to be caught swimming without their swimming trunks on when the tide falls. And we're going to see that. And people who are, doubling down, they're taking emotional buys right now, and they're saying, "Oh, my stocks are doing so well, I got to buy more." Well, they're the ones that are buying high right now, and they're going to see their portfolio cut in half overnight. So, the biggest indicator that I'm looking at is the multiple on book value that many of these stocks are trading at right now, which is just not sustainable.
Yeah, I was going to ask if you felt that that we have a little bit of a feel of that dot-com bubble situation arising, and you brought up inflation and taxes. We're going to get into that a little bit later on another question. So I don't want to dive too much more into that right now. So let's move on to the next question. So the next question is going to deal a little bit about diversification. You've got
Okay.
different operators and different money managers that look at diversification a little different. You got people like Buffett that you just mentioned, and his partner, his used to be partner Charlie Munger. They always looked at diversification is kind of how they put it is the diversification is for the stupid investor. Somebody that does not know how to evaluate should put their and spread their chips across many investments, and enough of them will do good that they should do good over the long term. However, if you have the ability to smartly and intelligently look at a investment, you should be able to pick a few good stocks, is what they did, obviously, stocks and companies, and they never felt that there was more than a couple that were really worth putting a lot of chips into. And then you've got other people like your typical financial broker who's going to try to spread you across as many assets as they can. Sometimes that's because they earn a fee off of number of trades that they make or whatever it is. But there's obviously different ways of looking at it. So most people think they are diversified because they own a bunch of different funds. Why is that false diversification? And what does real diversification actually look like?
Yeah, well, you brought up obviously Warren Buffett and Charlie Munger, and from a investment perspective, I would say they were diversified because they're not playing the stock market. They're not playing Wall Street like most people are. They're taking controlling interest in publicly traded companies. So they are diversifying, no different than a private equity company does. They're not, buying 10 shares of Apple and 100 shares of Walmart, and they're buying a controlling interest in the companies that they get involved in, or in the Coca-Cola instance, or some of the larger ones, they're still buying enough shares that when they move shares, it moves the valuation of the company. So, you know, diversification in most financial advisors' eyes, most of the time, most of our viewers, most normal investors that have a significant net worth, they've maybe they haven't hit a 5, 10, or $15 million net worth, but they've taken that slow growth strategy that some people talk about, like take a Dave Ramsey, for example, that really pushes, slow growth, put your money in an investment, live below your means. And so we've got a perfect example. I've got an investor that he makes 150 to $180,000 a year. Okay. And we met with him in the office the other day. If you looked at him over his 28-year career, he's never qualified as an accredited investor by income because he has hit, right around 150 to $180,000 at max. But he lived on 40-50% of his income, and he's done a good job investing. And so he's built about $1.5 million, $2 million net worth. And most individuals like that work with a financial advisor, they walk in off the street with a Fidelity, off the street Schwab or Edward Jones, whatever it is, that advisor is going to take the simple approach of saying, you're going to diversify across these mutual funds or these investments. We're going to put you in, a dozen different investments, whatever that is, but it's all Wall Street related. So when the market has a 500-point correction, it's impacting the majority of your investments no matter what. And when the president tweets something or engages in war, whatever the case may be, everything that you're invested in is impacted. That's not diversification. Diversification is multiple asset classes that are counter correlated to each other. So you've got Wall Street and whatever happens over here, but you've also got some real estate. And your real estate is impacted by supply and demand of real estate. And as we know, since 1975, America has always been in a deficit of supply to demand for housing. And now there's submarkets and markets that maybe have met up with demand for a period of time, but by and large, supply has fallen behind demand because of the growth in population in America. And so that is counter correlated to whatever happens in the market. Yeah, interest rates can swing. So we've seen the equities market hit record highs for the last 3 years. However, interest rates were extremely high, so it impacted ultimately cash flow in real estate, which shouldn't be the only thing that you're looking for in real estate. Which that's something that's a question we often get. So hopefully that's one that you'll get into a little bit
Yeah,
later.
we
But
actually have one on cash flow a little down the line.
Perfect. So diversification is different asset classes. You've got maybe 5 or 10% of your investments in, you know, precious metals, tangible precious metals, gold, whatever it may be. You've got 30, 40, 50, 60%. And we've got some investors, they have their own real estate portfolio and then they're invested with us and other real estate operators. They've got 80% of their net worth. Now their net worth is 10, 20, $30 million. So a little bit different, but they've got 80% of their net worth in real estate. Okay. Depending on what your net worth is, that may not be the best avenue to take, but 20, 30, 40, 50% of your net worth in real estate or private investments, and then another 40, 50%, whatever it is, in the stock market or in stocks, bonds, mutual funds. So true diversification is different asset classes, not Walmart and Coca-Cola and Apple. That's not diversification.
So, kind of going off of that, I mean, that kind of tells me you're not going to see or get from most traditional financial advisors, you're not going to get true diversification because they're just going to put you in different sectors of the market, which, as you said, and I completely agree with, that's not diversification. If the market goes down, you're still going down across the board.
Yeah.
All right, so going into next, we're going to talk a little bit more about inflation and taxes. Inflation and taxes are one of the true killers of both wealth building and wealth preservation. So, what in the simplest way can you explain the math to someone who thinks they're doing fine? How is inflation killing them, and how are or what can they do from a tax standpoint to try to offset that and beat that a little bit?
Well, inflation is simply buying power of your dollar. Okay. So a dollar today impacted by inflation or the cost of goods buys less in goods a year from now. Okay. So if you have $100,000 today and forget about earning anything on it or paying taxes on it, you've already earned your money. You earned the $100,000 and you took, you took that money and instead of investing it, instead of doing what is best for you and your family and investing that money so it goes to work for you, but also instead of spending it and blowing it on, whatever wasteful purchase you can make today on $100,000, whatever it is, you just say, okay, I'm going to put this $100,000 in a bank account. I'm going to set it here in a bank account. Okay. That is almost as bad as just going and blowing it because you put $100,000 in your bank account today and where inflation has been over the last 3 years and where it currently is. And yes, CPI is trading around the consumer pricing index is right around what, 3.2% right now,
Mhm.
3.1%. It's getting down to the close into the twos where they want it to be. However, keep in mind that does not take into consideration, as we've always said, the CPI inflation number does not take into consideration food or fuel, which are two of the most inflated items right now. If you take those into account, combined CPI would be closer to 6%. Because if you look at food and fuel right now, they're close to double digits. Okay. And so let's take that number. Let's take a blended number. Let's say inflation is 6%, including food and fuel. Okay. So you had $100,000 that you put in your bank account today. A year from now, that $100,000 is only worth $94,000. Okay. So
Okay.
now you've already lost the value of that money to begin with. Now, let's assume that you took that $100,000 and you invested it in the stock market today. And taking that article from the Wall Street Journal, I can't remember the guy's first name, last name Arnold. If you invest it in the stock market today, there is a looming correction coming. It is coming, no doubt. Is it a 20% correction? Is it a 50% correction? I don't know. We can speculate. It doesn't matter. Forget that. Let's assume that the correction happens and now you've invested $100,000 and taking what professionals are saying over the next decade, we can expect a 3% average annual growth on your stock portfolio. Okay, 3%. So You invested $100,000. A year from now, that $100,000 is worth $103,000. Okay. But inflation impacts it by 6%. So now it's only worth $97,000. Okay. But let's say that you also want to access that money a year from now. You put it in in an investment fund because you want to buy a house a year from now. Another terrible idea. Unless you're worth 10, $20 million, you shouldn't be buying your home. Once you're worth enough to have more than one home, and it doesn't matter if, let's say your employer, I was in this position really early on in my career where, let's say your employer, something happens, maybe they're bought out or they relocate or they need you to relocate and you just bought a house. If you have not lived in your, and especially with interest rates today, when interest rates are in the 2% range, it's not as bad of a deal. But when they're at 5 or 6%, if you don't live in your house for at least 7 years, you're losing money. If interest rates are at 5, 6, 7%. So let's say you bought a house and a year later, your employer needs you to move or you have an opportunity to move, you're losing money. Okay. So rent and invest that money. Buy a house that you rent out, whatever the case may be. Okay. So regardless, you invested $100,000 today. You want to access that money a year from now and you were wanting it to grow by a little bit. So you invested in the stock market. It grows to 103,000. Inflation impacts it. So it's worth 97,000, but you sell all your stocks. Guess what? You're paying taxes on those $3,000 in gains. They don't look at it that you lost from inflation. You had $3,000 in gains. So you're going to be at best you held it for a year and a day. Is that right? You're the tax guy. A year and a day is
Yeah.
long-term capital gains at that point, right? So $3,000 is hit at the 20% mark on taxes, right? So you're going to pay $600 in taxes. So now you're at 97,000 less the 600 in taxes. So you're at 96,300. Okay. That is the impact of taxes and inflation. Whereas with real estate has really four factors that I'm always looking at. One of them is cash flow. Okay. Cash flow can be impacted. You can have zero cash flow and it's still not going to negatively impact the investment because you also look for appreciation or growth, which you get. That's what you're looking for in the stock market, right? So you got that 3%. So let's say, I'm always looking for markets that have a really conservative 2 to 10% appreciation in value consistently over a 25, 50-year period. Okay, so let's just say that it's at 3%. It matches the stock market. Fantastic. You got 3% growth and you had no cash flow. So we're looking at a property that I probably wouldn't buy, but you're still focusing on equity. We're buying a property that has a discount on the front end. Either it's under market rent, so we're buying it. It's had an owner that's owned it for 12 years. He got lazy. He doesn't have any debt on the property anymore. So he hasn't increased rent because he didn't need to. We're going to step in and we're going to increase rent. Or it's got a little bit of value add that needs to be done. So we implement the value add and then we increase rent. Okay. And so or in today's market, which is the biggest opportunity that we're seeing, because we're seeing deals finally at 50, 55, 60 cents on the dollar because we've got operators walking away from equity because they don't have the cash to finish a project or close out a loan that is coming due and maturing and get new debt at a higher interest rate. So lenders are taking those assets from an operator. And if you have capital, you have the opportunity to step in and negotiate a discounted loan payoff there. Okay. And so now you're buying equity and you've got the tax advantage in real estate. So now inflation is taken care of because it's matched with appreciation. And if there's some cash flow, that helps out. But you're buying the discount, you're buying the investment at a discount. So you've got built-in equity from day one, and there's a tax advantage. And so now that far outperforms anything else that you can do.
So we're actually going to build on what you're talking about a little bit there, going into the cash flow metric of real estate. So obviously there's, we have our four key pillars that we look at when we are evaluating a real estate deal. There's a number of indicators when you're looking at a or underwriting a business or any investment opportunity. Why, in speaking specifically in real estate, why is looking at cash flow sometimes or in certain real estate cycles, why is cash flow the wrong scoreboard to look at? And, what should investors measure instead if they care about the long-term outcomes?
So cash flow should be a bonus, right? And it is in our four pillars, that our four keys to wealth as it pertains to investments. But it should be a bonus. I'm going to go back to the old adage that it's real estate 101. And whether you heard it from Donald Trump, Robert Kiyosaki, whoever it is, you make your money in the buy. Okay. So you make your money in the buy. If you're not buying at a discount, then you might as well just invest in anything else, right? Now you're not getting the value of real estate. The huge advantage to real estate is you're buying an asset, a physical asset, that if you find the right motivated seller that is motivated for whatever reason there may be, and we've got 100 of them that we use when we're marketing for off-market real estate, you make your money in the buy. If you're simply buying for cash flow, there's a good chance you're overpaying for the property, because you may have cash flow in let's face it, we've had assets that cash flowed in 2020 and 2021, and come 2022 there was zero cash flow because what inflation started to do to the tenant base. It didn't make it a bad asset. Didn't make it a bad asset at all. We bought it at a steep enough of a discount, half of replacement value. So now, there's operators out there right now saying, oh, the big thing to real estate right now is buy just below replacement value. Well, forget that. That's not a discount. You buy right below replacement value, you're competing with somebody else who's out there building a new asset, a brand new asset at replacement value. Why not just invest with them? Right? So you should be buying an asset and investing at well below replacement value, so that when you stabilize the asset and it's performing optimally, you can sell it at above replacement value because of the cash flow on it at that point. But don't be the buyer who steps in and buys it in that position. So the thing that I look for is equity, or how are we buying it on the front end? What kind of a discount are we getting and why? You don't want a surprise discount that you haven't accounted for, but you want to know what the variables are that are generating this discount. And the biggest one that I like is just a tired landlord that's owned the property for too long, and they don't want to step in and do the renovations to the property that need to be done in order to hit market rate rent.
So there's that's obviously one of the situations that creates a buying opportunity. You touched on the other one just a minute ago, talking about where we are in the debt cycle. So the last 12 months, we've seen the the lenders go through and try and clean up their REO tapes and sell off the bad loans that they've got on their balance sheet. Now we're starting to get into the cycle where the loan servicers have kind of come to that party and started trying to do the same thing. There was a time frame where everybody, it was basically just extend and pray, continue to hope something was going to correct
Extend and
itself and
pretend. Extend and
extend,
pretend
pretend,
that this asset
and
doesn't need more capital.
that it doesn't need more capital. And eventually, the chickens come home to roost. You get to the situation to where it is not a. I actually listened to a deal on Warren Buffett, a talk he gave just the other day on some of his lending that he does on manufactured homes. And eventually, if you get to a point where the situation is not good for the owner, it's also not good for the bank or the lender or the servicer, whichever one. And you have to have something has to get done. So in that situation, what does a good asset, bad capital stack mean? And why is that creating some of the best opportunities that we've seen in years?
Yeah, well, it's a very simple answer that I think gets often overlooked by many operators and or many potential investors, passive investors. A good asset, bad capital stack just means that you've got an asset that has upside potential that the business plan has not been able to be implemented because an operator or the owner has too much debt. And so too much of the capital is going into debt service and not able to go back into the asset as retained earnings. So, you and I have an accounting background. Retained earnings is one of the most influential things in order to continue creating value in an asset. Whether it's an asset that could benefit from having covered parking added to it, and we could go in and start charging 85, 100, $115 a parking spot. But all of a sudden, all of the cash flow is going to cover debt service, and we're having to do capital calls to cover operating expenses. That is a good asset, bad capital stack, too much debt. So we don't have any, or anybody, investor, whoever owns the asset doesn't have enough cash flow in order to manage the maintenance on the asset. And so what ends up happening in that circumstance is deferred maintenance starts to stack up. You don't notice that for about 12 months. Then 12 months later, you start to notice it and you start having tenant turnover. So the tenant moves out, which then compounds to the deferred maintenance, because now not only do you have the deferred maintenance that has happened for 12 months, you've got a tenant that moved out. And so now you've got a $1,800 to a $3,000 renovation to a unit to get a new tenant in, and you have no cash flow to cover those costs. And so now you either have to go to a capital call, or you're faced with declining occupancy. So, we've got one of our lenders. We've also got a number of other lenders. I was reading a number of articles this week. There was a big lender that just sold a $900 million debt portfolio for 50 cents on the dollar. They just dumped it because they ended up taking these assets back. Operator didn't have enough capital to bring in. Operator wasn't managing the asset, and cash flow was not enough to cover debt service and to deal with the deferred maintenance and managing the asset. And so they took these properties back at 25 to 35% occupancy, because 12 months went by, occupancy stayed reasonable, deferred maintenance stacked up. Then all of a sudden, a slow decline in occupancy, but there's no money to address the first deferred maintenance and now the decline in occupancy. And so the property just gets flipped, turned upside down. So, it's key. Capital, the root word of capital in the Greek means current, okay, or fluid, movement. Money has to move in order to build value. And we've got some really good assets that I really, really like, that with the right capital stack produce strong cash flow. With the right capital stack have huge upside potential. And they're in funds right now that have owned the asset for a number of years. That fund is ready to move its capital, but we don't want to get rid of the asset. So bring in a new capital stack, replace the capital stack, and reset the asset, and bring in the value there. Maybe it's taking the asset from a workforce housing property to a student housing property. That's a big one right now. There's a lot of colleges right now that have a huge demand for housing right now. And with student housing, you're going to get in some places $450 a bedroom, in some places as high as $700 a bedroom, and some are even higher than that, like Austin's University of Texas and things like that are higher than that. But 450 to $700 or $800 a bedroom, whereas a 2-bedroom apartment rented to the traditional workforce housing B-class tenant is going to bring in $900 to $1,000. Well, if you've got a student or two students that move in at $650, now you've got $1,300 a month in rent. That's $200 to $300 more a month in rent for that same unit. And so you've got to be able to upgrade the asset, though. You've got to be able to upgrade the unit in order to recognize that. And so that's a perfect example of a good asset, bad capital stack.
So yeah, I think it creates there's two different types of opportunity. You kind of touched on both of them. Number one, it creates market opportunity with uh, either the banks or servicers, whoever it is, wanting to offload stuff they've already taken back because they don't want to have to dump capital into that asset. They want to get it off the books as quickly as they can. Most of them are, lending out money off of a market line from somebody else. So they want to get that thing off their books, free their lines back up, and start moving money again. But the other thing it does is actually create opportunity to reset basis on some of the assets you have. We've got a lender that is willing to take a 30% haircut just to get a property off of their loan
Their
tape that they
balance.
don't want. It's a great asset, but they understand, we've had great communication with them, great talking with them and everything. And we both understand that there is not a pathway forward that is a win for one side. And so you have to create a win-win scenario. And the only way is us as an operator bringing some new capital to the asset, but them as the lender taking a little bit less of a repay on their loan balance. And so it creates multiple types of opportunity.
Yeah, well,
Um,
I think you bring up a good point there. And that's only feasible to operators who have access to capital. What we're seeing is 75–80% of the operators right now don't have access to capital. So you've got operators like us who are going in and we're using this opportunity as a chance to negotiate with our current lenders for discounted payoffs, which is buying free equity for our investors, which is a huge opportunity. There's not many operators out there that can say they're doing that. That is how we are winning for our investors right now. We're going in, and Boone, you've done a great job of managing our lender relationships and building rapport with those relationships. So when the time came when there is blood in the water all across the real estate market, where our lenders have other operators that are just walking away from assets and leaving them to the lender to manage. They don't want to manage those assets. So you're able to step in and say, hey, lender, I'm not going to pay you off in totality right now, but we will pay you off if you're willing to take a haircut on that loan and take a $20 million loan that we pay off at 15, $16 million. And all of a sudden we get $4 or $5 million of free equity for the fund. But to the flip side of that, like I said, you've got to be able to have equity and capital. And when you have capital, you can also go to that same lender and say, hey, I know you've got other operators right now that are walking away and leaving you with a bag full of a mess right now. I'm willing to step into that mess. Let me take these other assets. I'm not gonna do a 30% haircut on that. We're doing a 40 or 50% haircut on that, and we're bringing capital to the table. And so it creates a huge opportunity. We're seeing some of the best deals that I've seen in 25 years.
so you talked about having to be well capitalized to be able to do that. So obviously that takes, our clients have, put a tremendous amount of capital with us. We have people come to us every day wanting to place capital with us. So say you've got somebody that's got $250,000. They're looking to deploy it. What are the three filters you'd use to decide where that money belongs, whether it's equities, real estate, on the sidelines? Do they diversify it across a multitude of assets? What are the things that they need to take into consideration? Speaking of their age, their risk profile, and everything like that, to decide where they should place that money.
So, if I heard that question right and concern right, is they've got $250,000 to deploy, and it sounds like that's all they have to deploy. We've got investors, as everybody knows, our minimum investment's $100,000. Our average investment is right around $400,000 though. So most of the investors that come to us are not deploying $100,000 or even $250,000. It's 400,000. And so, you know, when somebody has um $250,000 to deploy and that's all they have to deploy, that's a different question than typically what is happening with us. We have a new investor come in, and right now we don't have an opportunity. We just closed out one of our fund opportunities, and we're looking at a couple of opportunities to open back up. But if an investor comes to us and says, "Hey, I'm looking for a new operator. I've got capital with, four or five other operators in diversified assets. I'm in some private equity deals and some stuff, and I want to get into some real estate, but I want to be diversified. Most of the people that we talk to, they don't want the single asset risk that most of the other real estate investors create. Most of our competitors raise capital for a single deal, and so their investors go into that single deal. And our investors know that we diversify across multiple real estate investments in one fund, and so they can be in private equity, then they can invest with us and have multiple exposure to real estate. And so in that circumstance where somebody says, I'm looking for a new relationship, I want to dip my toes in the water with $100,000. And then if that goes well, I've got four, five, 600 or $1 million to deploy. We get that a lot. Versus that's a different story. Somebody that has $250,000 to deploy and that's it. So with the person that has $250,000 to deploy, I'm going to look at first, what is their current circumstance? Do they need do they need liquidity for because it's $250,000 and that's really all they have. Let's say they have $1 million retirement account that's locked up and it's locked up for another 10 years before they can retire. And they've got $250,000 to invest right now in post-tax dollars that it's just cash that they're looking to deploy. But that's all they have. Let's say they live in a home that has a mortgage on it, so there's a good likelihood that they need some liquidity with that $250,000 because there may be a life circumstance away from needing 10,000, 50,000, or $100,000 of that for whatever the circumstance may be. Okay, so in that circumstance, if they're needing some liquidity, I'm going to say you need to look at how you deploy this $250,000. Maybe you put a small portion of it, maybe you put half of it into an illiquid investment like real estate that has a 3, 5, 7 year time horizon on it. But then you need to put the other half of that into investments like stocks, bond, mutual funds that has a liquidity factor to it in case you need access to that money. And so then in another instance, somebody that may have some money already in equities that has a liquidity factor, then I'm going to say, yeah, let's diversify that and put it into an illiquid asset that's going to have higher overall earning potential, but you're not going to be able to access that money for 5 years. Then, somebody who is young, they don't have anything in a retirement account yet. Maybe they just hit a payday, a big bonus or something from a sales commission, and they've got $250,000 to deploy. I'm going to say, you're young, you haven't proven to make great decisions yet financially. Let's be a little bit more cautious about where we deploy that. Let's keep some in cash, set it on the sidelines, because you're highly likely going to have an opportunity in front of you in the next couple of years that you needed to be able to deploy money really quickly. Let's put a little bit of that in equities, and then let's diversify the last $100,000 into a long-term investment like real estate. So it's really going to depend on the circumstances as to how we look at that. And those circumstances are highly dependent upon, do you absolutely need access to that money tomorrow or in the next year? And if the answer is no, then you should be looking for, how can I maximize that investment? And the best way to maximize it is buying an investment at a discount that has huge tax advantages, that is in a proven appreciating market, and that when everything plays right, it has a little bit of cash flow to it.
Yeah, that's obviously we are not a investment advisor or anything, but we look at each person's needs and try to match up. Not every person, you know, sets up well to be a good client of ours. If you're needing liquidity from your money in 3 months, well, then you're better locking that thing up in a CD or whatever. It's not good to place it into a real estate play that's going to be a five, potentially 5, 6, 7 year horizon.
I will
But yeah,
also say real quick before we move on though, you bring up a good point there. Somebody that has been able to create a $250,000 deployable capital, short of them being 80 years old and that's the first time they've had $250,000 to deploy, then you don't necessarily need that money in a short period. Like
Yeah, no,
they
that's a
may
good point.
say that. In fact, I talked to one of our doctors today. He's 61 years old and he's got about $250,000 to deploy. He's like, I would like to be able to access that money as I retire in the next 2 or 3 years, but really, that's less important to me than that money producing some sort of income to me. Maybe a little bit of cash flow at some point over that time period, and definitely growing in value. He's like, I've got another year or two to create another amount of capital. Anybody that can create $250,000 of capital, they should invest that money and invest it in what's going to earn the best for them and go create another $250,000 windfall for yourself.
Yeah, absolutely. So, all right, next we want to jump into a little bit, and we obviously continually tweak our investment thesis. We continually change, how we operate within whatever fund we're operating in. I want to talk a little bit about leverage. So, what does discipline leverage mean? Certainly in this market, how do you avoid being forced into a bad decision when debt matures? And then to go on top of that a little bit, what do you see a good level to be at from a leverage standpoint in our current market?
Well, obviously leverage, if you use that word the root word there is to compound whatever it is that you're doing, right? So you always hear levered IRR. I see a bunch of investors out there right now promoting levered IRR, and they're hitting these 30, 35, 40% levered IRR. Well, fantastic. Do you know what that means if you're an investor? That means they're going and getting the maximum amount of debt that they can get and hoping that the asset covers the debt service on that because debt is cheaper than equity. Okay. Well, fantastic. I would much rather have an asset that we've got 50% max leverage on, 50% debt, that, yeah, we've got to put more expensive capital in because we pay some of our investors a 14% preferred return. That's expensive. However, we can do that because if we go out there and get less debt, the property is going to cash flow much quicker than if you have 70, 80, or 85% leverage. You're going to have some cash flow much quicker. You're still going to have the appreciation and you're buying at a discount. So you're still, if you combine everything together, if you combine all the aspects plus the tax advantages, we're still hitting a 20%. We're underwriting deals right now very conservatively as an accounting background at north of a 20% IRR. And that is taking into account very, very, very low leverage. So, I think for us right now, the right range is somewhere at 50%, 55% of the value of the asset. And maybe that varies on a deal by deal basis, depending on what all of those four factors that we look at are. But 50 to 55%, if you're at that number and you've bought the asset at a discount, you're going to cash flow pretty quickly. Now, it's going to depend on, do you have a huge value add that is going to constitute you taking a property that you bought at 75 or 80% occupancy and you've got to completely change the tenant base. And so you've got to push it down to a 10 or 20% occupancy. Okay, there's some factors to consider there. How long is it going to take you to do that and so on and so forth. But by and large, I would say 50 to 55% of the value of the asset right now is a good range to be in when the debt markets are so speculative and all over the place.
Yeah, leverage, a leverage allows you to scale but must be sustainable.
Yeah.
And you got to be able to um, use a disciplined approach when going about it, when using it for underwriting. So, all right, next we're going to talk about um, this is a call a question we get asked on the phones a lot from potential clients. Um, you have a potential client calling in, they've been burned before. They've lost money in a deal, which obviously that happens. There is risk in investing. Everyone knows that. You touched a little bit earlier about how we, um, you know, mitigate some of that risk by utilizing a fund rather than single syndication. But you've got an investor who's been burned before and is convinced that every private deal is just another pitch. How do you separate stewardship from sales?
So I think there's a few things that you've got to look at and consider here. Number one is many people that I talk to, they look at, well, I've got a deal that it's not paying me cash flow anymore, so the deal is just completely bad, and it's ruined. Well, the fund hadn't even exited yet, or the real estate property hadn't even sold yet. So you don't know how your investment's going to perform at this point. That's a speculation. So first of all, let's compare apples to apples here. So you take somebody in that scenario, but yet at the same time, they've got a stock portfolio that has a market correction, and they had a $500,000 invested into the stock market, and it dips down to $460,000. Well, yeah, it's down, but they haven't recognized a loss. They're not going out and selling those stocks, are they, and recognizing the loss. The same holds true with operators and real estate investment. Just because it's not performing exactly like you expected during the hold period doesn't mean that it's a loss. Okay, so that's scenario number one. But scenario number two is, I've done 1,500 real estate transactions, give or take. You and me both have. And you're not going to bat 1,000. Like, especially with that many deals, you're going to have some losers. We've lost a handful of assets, like completely lost them and lost all the equity in it. That two things. That is the number one reason, based on my background in private equity and accounting. That's why we did a private equity approach to real estate instead of an operator approach to real estate. Operator approach to real estate, who's somebody who, jumps in and says, I'm going to do this real estate thing. They don't have a finance background, a accounting background, or even a real estate background for that matter, and they just jump in. Oftentimes, they're raising money for a single deal. And so you do 1,500 deals, one of those deals is going to lose money. And so all the investors in that deal is going to lose all their money. Well, that doesn't necessarily make the operator a bad operator. It doesn't necessarily mean the investor's been burned. It was a bad approach that maybe didn't fit what that investor was trying to accomplish. And so we've taken a fund approach, whereas we've got funds that have lost a couple of deals, but the fund itself is still going to perform positively because we've diversified within the fund. And so I think that's something that you've got to look at, is this an operator that, take Trammell Crow, one of the biggest private real estate investors in America. And they've lost money on deals. In the 80s, they lost money, and they actually have a things I will not do again sheet. You can get it. It's a checklist. There's many things on that I've learned we've implemented in our business because of things that they found out on deals that they lost money on back in the 80s. And so doesn't necessarily make the operator bad. However, there are bad operators out there. Bad operators that have lost everything. They end up getting on a jet and heading back to India or to Aspen or Chicago, wherever it is, to go run from the problem. And those operators, Boone, you and I have had partners like that didn't invest in their own deals, didn't invest in their own deals. And then they tried to say, well, we were only investing in our own deals for, you make up the reason, whatever it is, right? And or they said, we didn't invest in the deal because we didn't believe in it. Well, then why are you raising money for it, right? If you didn't believe in the deal or you felt like there was a problem, but you were out there raising money for it, that becomes a stewardship problem. So I'll tell you right now that if I'm looking, I've lost money before. I've lost money in investments. I've lost money in investments that we've had, and I've lost money in investments with other investors. If I'm looking, I want to be investing in with somebody who puts their own money in the deal right by mine. And so there's operators who will put money in as the GP, but they won't put it in as an LP. And they get their GP money back first before all the LP money comes back. You and I have invested in every single fund of ours. Not as a GP, we invested in the fund. And so you take one of our investors, and I had this conversation with with one of our investors today. They put their money in, we put our money in the same class as theirs, as a passive investor. So now I can sit here as the operator. You can sit there as the operator and wear the hat as the manager. Hey, what's the best thing for this asset for me to make a decision for all the investors? But we can also put on the hat as how would I like to be treated as an investor? And so that's a commonality, that's skin in the game. That is actually creating a scenario that is best for both parties. And so that's how I handle that conversation when it comes up. Like we've got out of our investors, out of all 750 of them, I can't tell you how many conversations I've had that they started out and they said, I'm skeptical of this because I've had an investment before and it was a Ponzi scheme and the operator went to prison. I've had an investment in a deal and the operator just was terrible operator and he often left and started up somewhere else. And in those circumstances, those operators don't have money in the deal along with the investors. And I've had other ones that say, I've lost money and here's what the structure looked like. And I tell them, I am not saying that we are going to hit every deal perfectly, but we've hit well over 95% of our deals positively. And I put my money alongside yours in every single deal that we do. And so now we've got that creates a structure that is a win-win for everybody.
Yeah, I think you made a good point. With us investing in each one of our funds alongside as an LP, it really helps us in the decision making process, and it actually helps us to, we are there's a lot of operators that when anything goes off the rails, they immediately jump ship, gone, don't know what to do. We have had deals that have gone, as you said, we've had deals that have gone bad or whatever, but we will fight, claw, and try to come up with any solution manageable to create a positive outcome. Because, as you said, we do have our own skin in the game. We're invested right alongside the rest of our LPs. So, kind of jumping into the last question here, it's going to segue into the last couple of questions we've talked about someone looking to deploy capital. So, if you had one rule for building money that works harder for you than you do yourself, what would that be? What's the first action or step that someone should take this week if they've got some money, or even if they don't have some money? What can they start doing to start putting capital to work for themselves?
So I say that all the time. I always say your money should work harder for you than you do for it. Okay. And that's first of all, that's the first rule. So rule number one is in the question. Your money should be working harder for you than you do for it. So, if you make $200,000 a year, you need to be finding a way that your money is producing you more than $200,000 a year in overall upside potential in the form of cash flow, appreciation, equity, and everything. Okay. Well, the rule for doing that is number one, partnering with somebody that is their full-time thing, is creating that opportunity for passive investors. I see far too often, perfect example is Boone, the investor that I'm talking about that had a very, very, very successful career as an entrepreneur, built a strong business, seven-figure earner, high six-figure earner, did very well, decided they were going to get actively involved in real estate. That is a terrible, terrible decision because no matter what you hear, real estate is not mailbox. The only way real estate is mailbox is when you partner with an operator who does that job for you. Because hear me when I say this, real estate is more than a full-time job. Boone, you and I know this. Our very first partner that we ever had that taught us construction. We started, I taught myself construction a little bit early on. Granddad helped a little bit, but then we partnered with somebody who had a 30-year company in construction. And remember the words that he told us is real estate, this business will eat
Eat
you
you
up
alive.
and spit you out. And he was talking from experience. He had gone through a triple bypass heart surgery and he functioned on half of his heart. Half of his heart was taken out, right? And it will absolutely do that. So if you think you are going to continue doing whatever it is that creates 200, 500, or $1 million a year for you and do real estate on the side, you are sorely mistaken because you may hire a third party property manager to go manage your properties for you, and they will manage to mismanage everything because they don't have skin in the game. It doesn't matter to them. Does not matter to them. They're going to do what's easiest for them. Okay. And so, rule number one is partner with somebody who it is their full-time career doing it. And you better make sure that that person has been through every kind of real estate cycle possible. Make sure that they've made money, they've lost money, and they've learned from it. Don't if you're working with somebody that says, I've never lost a dime in doing this,
Yeah,
then
they're
either
lying.
they're lying to you or they haven't been doing it long enough and they're about to lose a ton of money. So buyer beware. So partner with somebody that has been doing it long enough to have experienced a multitude of things, and then compounding on that, make sure that they are implementing those four keys to wealth as it pertains to investments. The best way to make your money work for you harder than you are for it is you've got to be hitting on three or four of those. You've got to be buying at a discount. Absolutely have to be buying at a discount. You have to be buying something that is appreciating in value. You need to be buying something that you have to be buying something that at some point during the investment it cash flows. It may not cash flow for a period at the beginning or period in the middle or even a period at the end, but it needs to cash flow and it needs to have a tax advantage. So if you have those four things working for you and they are working for you because you are partnering with somebody who knows how to implement them, then your money will be working harder for you than you are for it.
Well, and you ought to always get and hit at least on 50% because as you said, you have to make money in the buy. And so if you're not going to make money in the buy, you shouldn't be buying that piece of real estate. And
And if
every
you're
piece
making
of
money in the buy,
you're
every
going to
piece
get
of real
taxed.
estate has a tax advantage
Every piece of real estate has a
if
tax
if
advantage.
done right. If done
Correct.
right.
So, I mean, we utilize on our large assets, we utilize cost segregation, which allows us to speed up depreciation and create, significant losses in the first couple of years of the asset.
And
And
unlike
so,
most operators, we pass those through to the investors because we are an investor in the fund and
correct.
we need those losses.
Yeah, absolutely. So you ought to always at least hit on those two. And then at some point during the asset, it should cash flow a little for you. And if you buy in the right markets and underwrite in the right markets, you ought to see typical appreciation, at least a minimum 70 or 80% of the hold period that you have it.
Make money in the buy, location, location, location.
Yeah. And that if you hit those two right, then you're going to automatically hit on three of our four keys. And then as you said earlier, cash flow becomes the bonus.
Yeah.
So, well, that's the last question we've had. That gets us through, I think a really good set of data points and questions. A lot of questions that we've seen over and over from either current clients or potential clients, or just from people that listen to us on the show. So, really appreciate the back and forth, and really think you had some good insight there.
No, awesome. I think this has been a great one. So thanks everybody for joining us on, like I said, I think it's this 15th episode of the Growth Factor. If you have any more questions, if we didn't answer something clearly, please communicate with us wherever you're watching this, whether YouTube, social media, in an email, wherever it is. Comment or check us out at lasatercapital.com. That's LASATERCAPITAL.com. And definitely look forward to answering any questions that you might have. Otherwise, we will see you on next week's episode. So thanks, everybody.
See ya.